Hello and welcome back to the Microlearning Institute. In this tutorial we'll prepare the consolidated cash flow statement of the Zambezi Group for the 30th of June 20x6. In the question we are given the opening statement of financial position for the Zambezi Group at 20x5, we're given the closing statement of financial position for the Zambezi Group at 20x6, and we're also given a statement of comprehensive income for the Zambezi Group for year ended the 30th of June x6. Firstly, let's look at the goodwill situation. Zambezi acquired damp in the period, so we can see from note 1 that Zambezi paid 125 million for this acquisition. Zambezi acquired 70% of the fair value of the net assets of damp, which at acquisition were valued at $160 million. So this valuation equates to $112 million in terms of the share that the Zambezi Group acquired. So consequently we can see that on the acquisition of damp, the Zambezi Group recognized an additional $13 million in goodwill. So this information now allows us to reconcile the goodwill balances on the opening and closing statements of financial position. On the opening statement of financial position for X5, we see a total goodwill of $25 million. We've just calculated that on the acquisition of damp, the Zambezi Group recognized an additional $13 million. And when we look at the closing statement of financial position, we see $30 million of closing goodwill. So therefore, as a balancing figure, we can conclude that the Zambezi Group recognized impairment of goodwill in the period of $8 million. And of course this will be important later when we compile our consolidated cash flow, as this impairment of goodwill is a non-cash item and must be added back in the calculation of the cash flow from operating activities. Next up, let's reconcile the property, plant and equipment balances. So we can see on the opening balance sheet of September of 20x5 that the property, plant and equipment balance of the Zambezi Group was $1,005 million. We are told that on the acquisition of damp, the Zambezi Group gained control of an additional $70 million of property, plant and equipment. We're also told in note 2 that goodwill or depreciation in the period was recognized at $60 million, thus reducing the carrying amount of property, plant and equipment. And also, when we look at the statement of comprehensive income, we see an impairment in relation to property, plant and equipment in other comprehensive income of $95 million, also reducing the carrying amount of property, plant and equipment. When we look at the non-current liabilities, we see there's an outstanding payable of $144 million in relation to the acquisition of property, plant and equipment, and this increases the carrying amount of property, plant and equipment. And on the closing statement of financial position, the outstanding balance is $1,315 million in relation to property, plant and equipment. So again, as a balancing figure, we can conclude that in the period, the Zambezi Group added $251 million of property, plant and equipment, and of course this is a cash outflow in relation to investing activities. Next up, let's look at the interest payable balances. Again, the opening statement of financial position shows us interest payable of $45 million. The deferred consideration on the acquisition of damp is treated as interest in the income statement, and again we can see from note 1 that this is $4 million. In the income statement itself, we've got interest payable of $40 million and a closing balance on the statement of financial position of 20x6 of $50 million. And again, as a balancing figure, we can conclude that the cash that the Zambezi Group paid in the period in relation to interest was $31 million. Next up, we look at reconciling the tax balances, and when we're reconciling the tax balances, we can treat current tax and deferred tax simultaneously in the one working. So on the opening statement of financial position, the current tax balance is $185 million and the deferred tax balance is $25 million, giving us a total tax balance of $210 million. In the period, we recognize a tax expense through the income statement of $200 million. We look at the closing statement of financial position, and the outstanding tax liability there is $220 million. So again, as a balancing figure, we can conclude that in the period, the Zambezi Group paid $190 million to the tax authorities. Next up, we look at the balances on the associate account. And again, we know that the associate is an asset of the group. So the opening carrying amount for investment in associate is $290 million. This is added to by the amount through the income statement for the share of profit in the associate, which is $20 million. Now, we also see in the statement of comprehensive income that there's a foreign exchange difference in relation to the associate, and this is a loss of $5 million, which of course would reduce the carrying amount of the associate. The closing balance on the statement of financial position for X6 is $270 million. So therefore, we can conclude as a balancing figure that we received cash from the associate of $35 million. Next up, we look at the balances for non-controlling interest. Again, the opening balance on the statement of financial position for 20X5 is $45 million. Again, we see that the non-controlling interest take a share of total comprehensive income from the statement of comprehensive income, equating to $25 million. We see also that when the Zambezi Group acquired 70% of the net assets of DAMP, the non-controlling interest of DAMP was recognized at 30% of the fair value of the net assets of DAMP. And of course, 30% of 160 is 48. On the closing statement of financial position for X6, we see an outstanding balance in relation to non-controlling interest of $60 million. So therefore, again, as a balancing figure, we can conclude that in the period, the Zambezi Group paid dividends of $58 million to non-controlling interest. Now we can see that there is an outstanding balance with other dividends, because per the statement of changes in equity, we have total dividend payment of $446 million. We know that the investment in River, which is detailed in note 7, is $400 million. So therefore there were additional dividends paid that are not distinctly disclosed in the question of $46 million. Now, we're in a position to prepare the consolidated cash flow statement. So, firstly, we look at the cash flow from operating activity, or from operations. And again, this starts at the profit before tax figure, which of course is not a cash amount, but again it acts as a starting point in deriving the cash flow from operating activities. Firstly, we deduct the share of the associate, because of course this share of an associate is not a cash inflow, so we remove it in terms of arriving at the net cash flow from operations. Similarly, we add back depreciation and the impairment of goodwill, because of course these expenses that are recognized in the income statement are not cash outflows. Next, we also add back the interest expense, because that's not actually the amount of cash that we paid to our loan holders. And also there's a pension expense there, which again is an accrued amount and doesn't equate to the amount of cash that we as the Zambezi Group put into our pension fund. So a subtotal here at the end of this working is $781 million of cash inflow. Moving on, we can also look at the movements in working capital, and of course the movements in inventory between X5 and X6. So we can see from the statement of financial position of the Zambezi Group that the opening inventory is $580 million. We then see that when we acquired our control of DAMP, we acquired control of an additional amount of inventory of $90 million. So there you see the X5 amount adjusted for that $90 million. And we can also see on the statement of financial position for X6 a closing inventory of $650 million. So therefore, we can see that we have effectively reduced the amount of inventory in the period by $20 million, and of course this is a net cash inflow to the business. Similarly, with accounts receivable, our opening accounts receivable is $530 million, our closing accounts receivable is $610. So we can see that our our customers, our receivables, have more of our cash at the end of the period than they had at the beginning. So consequently, this equates to a net cash outflow from the business to accounts receivable of $80 million. Finally, the final element of working capital is accounts payable, and we can see that accounts payable went from $1,200 million in X5 to $1,341 million in X6. So consequently, we have more of our suppliers' cash, so this equates to a cash increase of $141 million for us. So this gives us a subtotal in relation to cash flow from working capital of $81 million positive. So just to finalize the cash flow from operations, the two subtotals for workings A and B total $862 million of cash inflow. This now is the actual interest paid, the actual check that was written to pay interest of $31 million. You'll remember that we've already adjusted the accrual from the addition from working A. Similarly, this is the $190 million of actual tax that we paid to the tax authorities. And finally, this is the actual cash that the Zambezi Group put into their pension fund. And again, this information is given to us in Note 5. So these adjustments equate to $228 million. So finally, we can conclude that the net cash that we generated from operating activities in the period is $634 million. Next, we can look at the cash flow from investing activities. And again, we calculated earlier that we purchased property, plant and equipment for a cash amount of $251 million. We also spent $100 million in the purchase of DAMP. We received $35 million as a dividend from our associate investment, but we also paid $400 million for our investment in River. So consequently, the net cash flow from investing activities in the period for the Zambezi Group is a net cash outflow of $716 million. Now we look at the financing activities, and again we can see from the opening and closing statement of financial position. The opening statement of financial position shows a share capital of $85 million and a share premium account of 15. And by the time we get to the closing balance sheet for X6, we see that has increased to an ordinary share capital account of 100 plus a share premium of 30. So consequently, we must have issued shares in the period and received cash of $30 million. Also, our loan accounts have moved from an opening loan balance of 555 to 621. So this equates to a cash inflow to the business of $66 million. We also paid dividends. You remember that adjustment that we did of $46 million, and dividends are classified as a financing activity. And we also paid additional dividends to non-controlling interest, which we've already calculated, of $58 million. So our net cash outflow from financing was a cash outflow from the group of $8 million. So our summary cash flows now, our cash flow from operating activities is $634 million in. Our cash flow from investing activities is $716 million out, and our cash flow from financing activities is $8 million out. So the net cash flow in the period is $90 million of a cash outflow from the business. Now we can reconcile that with the movements on the cash balances from the statement of financial position. We'll recall that we've just deduced that the net cash flow from the cash flow statement is $90 million. When we look at the statement of financial position for X5, we see a cash amount there of $140 million. When we look at the corresponding entry for X6, we see it's $50 million. So again, the difference between 140 and 50, as we had expected, is a net decrease in cash in the period of $90 million. Thank you very much for watching this short tutorial from the Microlearning Institute.